PEG ratio is a financial metric that combines the price-to-earnings (P/E) ratio and the expected growth rate of a company. It is used by investors to assess the valuation of a stock relative to its growth potential. The PEG ratio helps determine if a stock is overvalued, undervalued, or reasonably priced based on its earnings growth. The formula for calculating the PEG ratio is as follows. PEG ratio equals P/E ratio, annual earnings growth rate. Here's how you can interpret the PEG ratio. PEG ratio less than 1. A PEG ratio below 1 suggests that the stock may be undervalued relative to its expected earnings growth. It indicates that the market is not fully pricing in the growth potential of the company. PEG ratio equal to 1. A PEG ratio of 1 indicates that the stock is reasonably priced relative to its expected earnings growth. It suggests that the market is accurately valuing the stock based on its growth prospects. PEG ratio greater than 1. A PEG ratio above 1 suggests that the stock may be overvalued relative to its expected earnings growth. It indicates that the market is assigning a premium valuation to the stock despite the growth potential. It's important to note that the PEG ratio has its limitations and should not be the sole factor in making investment decisions. Here are a few considerations. Accuracy of earnings growth estimate. The PEG ratio heavily relies on the accuracy of the estimated earnings growth rate. Inaccurate or overly optimistic growth projections can distort the valuation assessment. Industry comparison. When using the PEG ratio, it's crucial to compare a company's PEG ratio to others in the same industry or sector. Different industries may have varying growth rates, risk profiles, and valuation metrics. Other factors. The PEG ratio should be used in conjunction with other fundamental analysis factors, such as financial statements, competitive position, management quality, and overall market conditions. Volatility and risk. The PEG ratio does not consider the volatility or risk associated with a stock. It focuses solely on the relationship between valuation and growth, ignoring other factors that may impact investment returns. The PEG ratio can be a useful tool for investors seeking to evaluate the relationship between a company's valuation and its growth prospects. However, it is important to conduct comprehensive analysis and consider multiple factors before making investment decisions.